Hey everyone, and welcome back to Novice Investing Guide, where we make investing easy for everybody. Today we're going to be comparing 4 popular growth ETFs, VUG, IWF, RSP, and IVW. We will pit them against each other in a cage match style battle, so stick around to see which ETF reigns supreme. These 4 funds focus on stocks that are expected to grow faster than the market average, which can be perfect for long-term investors. In the red corner, we have VUG, or the Vanguard Growth ETF. It's one of the most popular growth ETFs out there. It tracks the CRSP US Large Cap Growth Index, which means it holds large cap companies with strong growth potential. Some top holdings include Apple, Microsoft, and Amazon. It has a very low expense ratio of 0.04%, which means more of your investment returns stay with you. VUG holds over 200 stocks, giving you exposure to a broad range of growth companies. VUG also pays a dividend of 0.51% as of November 2024. If you are looking for broad exposure to large cap US growth stocks and want a low cost option, VUG is a great pick. It's ideal for long-term investors who want to capitalize on stable, large companies with strong growth potential. Next up, in the blue corner, we have IWF, or the iShares Russell 1000 Growth ETF. This ETF tracks the Russell 1000 Growth Index, which is similar to VUG in that it focuses on large cap growth companies, but it has a slightly different mix due to the index that it follows. IWF also includes top growth stocks like Microsoft and Apple, but is a bit more diversified with around 500 holdings. The expense ratio is a bit higher than VUG at 0.18%, but still a reasonable for a growth-focused fund. IWF also pays a dividend of 0.54% as of November 2024. If you prefer a little more diversification in terms of the number of stocks held, IWF could be a better choice. It provides a bit more spread across large cap growth stocks, which might help reduce risk when compared to a fund with fewer holdings. Now we have RSP in the green corner, the Invesco S&P 500 Equal Weight ETF. It is a bit different from the other two. Instead of focusing exclusively on growth stocks, it takes all the stocks in the S&P 500 index and gives them an equal weight. This approach avoids heavy concentration in the largest tech companies, which can sometimes dominate the growth-focused funds. With RSP, you get a more balanced exposure to the 500 largest US companies, with more equal emphasis on each one. The expense ratio is 0.20%, which is a bit higher than VUG, but comparable to IWF. RSP also pays a dividend of 1.5% as of November 2024. RSP is a good option if you want exposure to growth but with a twist. Equal weighting means you're not relying as much on the biggest companies, like Apple and Microsoft, which can help if you're concerned about those top heavy weightings. It's ideal for investors who want a broader approach within the S&P 500, but might sacrifice a little bit of growth to do so. And last, we have IVW in the yellow corner, the iShares S&P 500 Growth ETF. IVW tracks the S&P 500 Growth Index, so it has a strong focus on the growth-oriented companies within the S&P 500. This ETF has about 230 holdings, which includes a mix of large and mega cap growth stocks. The expense ratio here is 0.18%, similar to IWF, and is heavily weighted in tech, but also includes healthcare and consumer discretionary sectors. IVW also pays a dividend of 0.54% as of November 2024. IVW works well for those who want a focused growth strategy within the S&P 500. It's a little more concentrated on growth leaders within the S&P 500 than RSP, but provides a balance between concentration and sector exposure. Now let's talk about total performance. Growth ETFs like these can have impressive returns, especially during bull markets. But remember, they can also be more volatile, especially during economic downturns when growth stocks can fall harder than more conservative investments. Historically, funds like VUG and IWF have shown strong returns, especially in periods when tech stocks have outperformed. For example, VUG has averaged an annual return of around 15% over the past decade. RSP, with its equal weight strategy, may underperform in a growth-dominated market, but tends to be more stable because it doesn't concentrate on the largest tech stocks. Take a look at this chart, which is the previous 5 years, for each of the 4 ETFs' total return, dividends included. Let's talk about expense ratios. Expense ratios are crucial to consider when investing for the long term. VUG has the lowest expense ratio out of these 4 at 0.04%, which is appealing to cost-conscious investors. IWF and IVW both clock in at 0.18%, and RSP is not far behind at 0.2%. While these may seem like small differences, over time, lower fees mean more of your investment stays in the fund. Growth ETFs can be fantastic for investors with long time horizons, but they also come with risk. Growth stocks are sensitive to economic cycles and interest rate changes, which means they may be more volatile. So if you're investing in a growth ETF, it's good to have long-term perspective and be prepared for some volatility. It looks like our contestants have taken their corners, so let the match begin. VUG comes out swinging with the lowest expense ratio and takes some early shots at the other ETFs. RSP punches back with its higher dividend and less volatility. IVW with some body blows for its diversification with over 500 holdings. And IWF from the top rope with his total overall return numbers. And at the end of the match, VUG and IWF are all that's left standing. Waiting for the official result from the judges, and by split decision, IWF takes the win, just edging out VUG in total return for the last 5 years, which is what they were judging on. For my goal and risk tolerance, I declare IWF the winner of tonight's bout. Your declared winner might be different, so take the data available and make the best decision for your situation. Comment down below for who you think won tonight's showdown, and we'll see you next time. Thank you for tuning in for tonight's heavyweight matchup of growth ETFs. If you found this video helpful, don't forget to like and subscribe for more investing tips and, of course, more ETF battles. See you next time on Novice Investing Guide.